Gold is on the rise as investors eye progress on tariff negotiations. The precious metal hitting several highs so far this year, but our next guest seeing gains for the precious metal potentially being capped. HSBC Chief Precious Metals Analyst James Steele joins us now to discuss. James, great to see you on set.
Well, thank you.
So maybe big picture to start, James. Gold has been a clear, glittering winner in 2025. Why, James? What are the reasons that explain this move?
Well, I think, you know, from the time that I started covering these metals decades ago, the same 12 or 15 factors drive them every year. The trick to looking at the market, I think, is to figure out which of those factors is in the driver's seat. And for the past couple of years, and especially this year, it's been geopolitics. And you get a lot of risk, and you get a lot of uncertainty associated with elevated geopolitical risk levels. And you're not really sure. It distorts capital markets. It does a lot of things. And gold being a hard asset and a safe haven will tend to be a winner out of that. And I would say, I wouldn't say it's the only reason by any means, but it's certainly a dominant one right now, geopolitical risk.
Something I'm really curious about is if the tariff risk starts to come off the boil, right? If we start to see deals being announced, is there still a scenario in which gold can continue to rise or at least maintain these levels?
Well, there could be, but that would remove one of the legs of the rally, without a doubt. I mean, one of the things that presses gold higher is economic policy uncertainty. It's not necessarily whether the policy is good or bad, which you could argue from whatever standpoint you are. It's the uncertainty that gold doesn't like. And if you take, for example, Mrs. Thatcher in the UK or Ronald Reagan in the US, there was clarity about what they wanted to do, whether you agreed with it or not. Right now, all the indications are, if you look at the geopolitical risk, or if you look at rather the economic policy uncertainty risk index, it's very high. And that's what's helping to feed gold. I think if we got some clarity on the tariff issue, that would help undermine it.
James, do you give your clients targets for the yellow metal? Do you say, okay, I think my year-end target for gold is X?
Well, we give a different sort of year ends. Averages is what we look at as well. But you know, the market now is very dynamic, and we also are obliged to explain the fundamentals and the drivers. I mean, HSBC is a large bullion bank, and we have a lot of physical clients as well as a lot of investor paper clients. People like mining, jewelry companies, mints, et cetera, et cetera. So we have a very good idea what's going on in the physical underlying market, because very often, I mean, right now is a good example where the two, there can be quite a cleavage between the two at times.
Interesting. So the demand for physical gold, in other words, right now is not seeing the kind of enormous demand that sort of speculative gold is seeing.
Yeah, I would argue that.
And what are the implications of that then in terms of future price action?
Well, one of the difficulties is that the investor demand is driven by hundreds or say thousands of fairly big individuals or hedge funds, portfolio managers, et cetera. And the physical market is bought and sold by millions of people worldwide every day. So it takes a long time for that to catch up. But last year, jewelry demand, which is 50% of gold demand, was down double digit. Coin demand is down because many people had already bought coins last year and the year before that. Small bar demand, I'll give you an example. The 10-gram bar is the favored bar in India, which is the second largest consumer in the world. And a few years ago, it was 35,000 rupees, and today it's around 100,000.
Wow.
So you can see how people would be priced out of that. Now, that accumulates, and we've had a lot of supply come on the market too. Because of recycling, it's very attractive to hand your gold back in, and mine supply is going up. But that doesn't necessarily mean the price will go down as long as the investment side, asset managers, central banks, portfolio managers, insurance companies, et cetera, and so far they've been happy to absorb that.
What have ETF inflows been like, James? Do you have line of sight there?
Well, the ETFs hit a peak during COVID at 111.5 million ounces. They went down to about 80 million ounces. They started this year at 82. They're up to 86, I think. But we have also seen an increase in Chinese-based ETFs. And that's been the big issue this year, I think. Although we've seen jewelry demand and things like that in China go down, we've seen the ETF demand has gone up.
And James, before we leave you, just quickly, so where do you think we're going from here? Do you have a particular, how much more do you think gold has to run?
Well, I think you hit, Josh, on the nail at the beginning. If we get any kind of a relaxation in geopolitical risks, any kind of clarity on economic policy, and if the dollar doesn't keep going down, then the market can top out a bit, but we're probably going to stay volatile and keep spiking to the upside until it's the second half of the year that we think we might see some more relaxation. Things are going to be too tense in the near term to get a big pullback.
2/10, good for gold. James, thank you so much for your help today. Appreciate it.
A pleasure. Thank you.